So I want to demonstrate this interactive browser that helps us to look at the local indices and a custom index. The Basically our models are three, and they're very closely linked. But the first model is the repeat sales index. On top of that sits the linear factor model, which is a national model, and then from the insights of the factors, we have a propagating wave, which is really a description of the well-known ripple effect as price, performance, capital price, capital gains um, on residential property propagate from high-priced regions, in particular prime central London, out through the commuter zones and into the lowest priced regions. And So I'm going to focus really on the index part of it. And what we're looking at here is the indices for East London. So we use postcodes quite a lot, and this is postcode area E for East London. There are 104 such postcode areas in England and Wales, and they're broken in total into 2,274 districts. And here in East London, we've split those districts according to their present value per square metre, using the indices themselves to revalue to the present, to reprice, and then at the aggregate level to divide the aggregated across hundreds or thousands of properties, the aggregate present value by the aggregate square metres. And in that way, we get high signal to noise ratio method for breaking down the area into its component districts. And here you can see E1W, which we're going to focus on for sort of a case study here. It's Wapping. It's between the City of London and the Isle of Dogs. It's currently priced around just below 10,000 per square metre. And right. So it's the highest priced district in the East London postcode area. So of course it's in the top tertile index, coloured blue. Green is the middle and red is the bottom. And the mean squared error, a measure of the accuracy of the index is the mean squared, is the RMS error. And we measure it both in sample on the training set and then out of sample on a testing set using the method of k-fold cross-validation. And they're very similar. That means we're not hugely overfitting the data. And they're around 13.35% in Wapping on estimated on itself. And mistake there, I included Isle of Dogs. So it's just 11.41 and 11.98 estimated just on E1W. And across the whole of that top tertile index, it's 13.1 and 13.18. So you will always get better fit more locally in sample, but not always out of sample. So this is quite interesting. There are Wapping specific effects that persist out of sample. That's quite important. Now we can augment this index, and I've already kind of gone through the permutations here. And what we want to do is augment it with one of the largest postcode districts in the City of London, and also C1V. And I think we can just make do with that one. Is it EC3N? Let's have a look. I'll know if I've got it right on the map. So they've been, yeah, so one is adjacent geographically, and the other is very close in price. We can look at the listing of the price of all of these districts. If we filter here on EC, on the City of London, we can see that that they're all actually higher priced than Wapping, but the one that's closest is EC1V, so that's why I included that one. And the other one that's close in a different sense is this one, which is right adjacent to Wapping, and so it's a natural fit. And what we find is that the accuracy, the out of sample um, fit is actually just marginally better, including those two. So now let's take that as our custom index just as an illustration, and we can go to this time series and look at the return and risk. And I think you can, so if we go back to the GFC, that's period 26, and we can re-zero on that, on the start of that period, you can see that the grey line is our custom index just for Wapping with its two neighbours, and the blue line is the rest of top tertile East London, and then the green line is middle priced and the red is bottom priced. And you can see that the fall in on the grey and the blue lines corresponding to the premium priced properties was just 18.5% and 16.6% in log terms. It's all listed out here if you want to check the numbers. That's where they come from. And whereas the fall in the lower priced indices was greater and persisted through the rest of 2009. And in fact, the bottom price tertile, which is the red line here, had a total drawdown of 0.322 in logs, in other words, 32%. And then essentially after a bounce, it flatlined. Whereas our custom index for Wapping shows a very rapid rebound. It only took 2 years to recover its 2007 high, whereas sort of these areas like Canning Town over here, for example, took 5 years to regain their pre-crash levels. So the crisis itself wasn't a cyclical phenomenon, but the rapid recovery of the high-price districts was. And knowledge of the position of the cycle would have made this foreseeable, that there would have been a more rapid payback, if you like, or recovery. And by contrast, in last periods, if we now focus instead on the last 6 periods since the end of period 40, since 2016, Wapping index has gently fallen by 5%, whereas Canning Town East 16, just beyond the Isle of Dogs over here, has fallen by 15.5%, I believe. No, sorry, is up 14.7%. Okay, so this is 14.7% up in logs, 0.147. So the spread of returns between these two is 0.199, i.e. 20%, and is very significant and foreseeable based on the cyclical analysis that I've described. The reason being that the factor vector resolves almost directly parallel to the beta vector that we were looking at before. So just to pull this up again, East London, I don't have it on here, but it's very similar to North London. And the factor vector is pointed from 0, 0, roughly in this direction. In other words, equal scores on factors 2 and 3. And that points down almost directly along here. And that means that the spread of these betas generates almost exactly the 20% of differential performance that I've just described and that you can see on the index listing. And that, in essence, is how this can be applied to get an insight into the size of the impact of a crash and the time for recovery based on the cyclical drivers. And the capital gains have got consequences both directly for the equity holder, maybe the homeowner, but also for the debt provider. The consequences direct for the equity holder if the property is liquidated, but equally it's going to impact on mark-to-market valuations using, for example, an AVM, in line with the proposed regulatory environment of MiFID 3.1. So gaining the equity cushion of 15% would obviously reduce the risk-weighted assets and free up capital for other profitable lending, whereas a 5% loss is going to work in the opposite direction. So I've been unable to go into the details of how the time intervals are computed. They're of different lengths. And I've also not gone into the details of how the price bands are selected either at the national level. I said they're roughly equally spaced in logs, but they're actually algorithms designed to sample both the time dimension irregularly and also the geographical locus of each index. And the criterion is a variance perspective, so we've got equal increments of variance. Like I say, I'm not showing that right now, but we can unpack that to the nth degree. So I hope I've given a flavour of the stack of models and how they can be applied, how they could be of practical use to both for equity holders and for lenders on residential property.